Hello and welcome to Insights to Selling a Privately Held Business. I'm Kimberly Deas, and together with my partner, William Yankee, we are business transfer specialists with Murphy Business and Financial Services. Today we're going to be looking at several items that are important to someone considering selling their business. We're going to start by looking at the local economy. We're going to look at sellers' questions and concerns, and we're going to overview the process of selling a private company. For example, what is the business worth? How to package the business, the financing options, and of course negotiations and closings. We're going to close out by common mistakes made by sellers. So let's look at the local economic outlook. Currently, in the Northeast Florida market, 96% of businesses expect to grow or be stable, and 92% expect the Florida economy to improve or be stable, and 80% expect the U.S. economy to improve or be stable. This information was obtained from the BMO Harris Bank survey published in the Jacksonville Business Journal. What this really tells us is there's this feeling of security in the business area right now. And what this does is this gives our buyers a sense of ability to purchase, that the business is going to continue to grow or at least be stable. The next indicator we're going to take a look at is the number of businesses sold over the past year. And if we take a look at Biz Buy Sell, which is one of the largest business for sale sites, we'll see that in the first quarter of 2013, we saw a spike in business sales, and that spike is continuing through the fourth quarter of 2013. What that tells us is we have a lot of businesses and buyers that have been waiting to purchase, and now is the time for sales to be happening. This is a very good indicator for a business owner that is considering their exit, as our buyers are currently, they do have cash and they are looking for businesses, so it is a good time for the sale of a business. Next, let's look at the business sale environment in general. Currently, we have both a buyer and a seller's market. Now, of course, this depends on the industry that you're in. Some industries, such as the financial or insurance industries, are much more of a seller's market today because there's fewer of them for sale than a buyer's market. In other areas where there's a lot of those businesses for sale, such as a restaurant, it may be much more of a buyer's market. So depending on your industry, it'll tell you whether we're a buyer or seller's market. Right now, though, we can confirm that good, well-organized, profitable businesses definitely sell faster and for a higher price. In fact, we recently listed a business that was doing about $200,000 in sales, and they were doing about $140,000 in profit, and they sold for $300,000 cash, and they were listed for only 7 days. It was a good, well-organized, profitable business, and we had a ton of buyers, in fact, a ton of backup offers. So if you have a good, well-organized business, there definitely is buyers out there, and we can attract them very quickly. And of course, right now, interest rates are very low, which allows a buyer to possibly borrow and makes it much more affordable. But there is a word of caution here with the baby boomer bulge. Certainly the baby boomers currently are in the approaching their retirement age, and many of them who have businesses may be looking to exit. This brings us to the seller's concern. There's approximately 10 million businesses over the next 5 to 10 years that are going to transition. And what that means is if you hold on to your business a little too long in specific industries, you're going to find that it becomes a buyer's market instead of a seller's market. This means that some businesses could be quickly devalued if the business owner holds on too long. So if you are considering selling, I want to make sure that you understand there is most likely going to be a flood of businesses entering the market over the next 5 to 10 years. And so if you are at that age where you're saying, maybe I've got another 5 years, you may want to consider exiting in 3 and missing the bulge so that you can obtain a higher value for your business instead of devaluing the business when the bulge occurs. So just a word of warning there for our sellers. So as a business owner, as you're considering selling your business, you often have lots of questions, such as, who will buy my business? How much is it worth? How do I find a buyer? Can I sell it to my employees? What advisors do I need? How long will it take? And there's often a lot of questions that go through a seller's head. And it's important that you work with advisors that can help you in developing that process, because not every business owner has the same options depending on the type of business and the way you've developed your business. So having a group of advisors to help you, that would include certainly your CPA or your accountant, would include a business attorney, and certainly you would not want to forget about having a business broker who has a sense and feeling of what businesses are selling for on a daily basis that can help you prepare and position. And it's certainly never too early to position a business for sale. Michael Garber says the best time to plan your exit from a business is the day you start your business. I can tell you from experience that many business owners who prepare their business early get higher prices for their business than those that have sudden events occur, such as medical events, family events, relocation events. Oftentimes those business owners have to take a reduction in order to sell the business quickly. So be prepared, and certainly reach out to your advisors as soon as you can to prepare your exit strategy. Next, let's take a look at the selling process. Let me give you a big 10,000-foot view of what the process looks like. The first step is you want to prepare the business for sale. And this can happen as early as 20, 30, 40 years before you ever sell the business. When you develop a business that's sellable, not only do you have a more profitable business, it's a more fun business to run. Then next, we determine the value. And this is something the business owners should be doing on an every 3 to 5 year basis. They should be having a valuation done so they know where their business is progressing and what the value is if they had to exit quickly due to a medical or other unexpected event. Then once you're ready to sell the business, of course, the business gets packaged. You're going to market the business. You're going to qualify buyers, accept offers, go into due diligence, and close the deal. And the rest of this webinar, we're going to go through each one of these steps. So first, let's talk about preparing the business for sale. A buyer is going to ask you for 3 years of clean books. Now, you might think, well, of course my books are clean, but let me ask you this. Do you have cash that is unreported in your books? Do you have inventory that is unaccounted for in your books? Do you have current events that have occurred that have adjusted your profitability, that were one-time expenses or non-operating expenses or income? These are all things that make books unclean and that need to get removed. So it's important that as you're considering the option of selling your business someday, that you make sure all the cash is reported, that you make sure that your personal expenses are nominal in your business. And lastly, you make sure that you track any one-time, non-operating or non-reoccurring events so that these can be added back. Now, of course, you also want to make sure that you're paying all your taxes. This includes sales tax, employee tax, and personal property tax. We talked about the cash being accounted for. And, of course, you want to make sure the business is ready to transition. That means that if you are doing everything, unfortunately, you will not be sold with the business. Only your information that you leave in the business will be sold. So do you have processes for everything you do? Do you have everything documented? Are there people that can replace you and the knowledge that you have? And if that's not the case, then these are things that you need to put in place. You may need to bring in an assistant. You may need to bring in a protege to be able to disseminate that information so it stays with the company and is not lost when the business is purchased. Now, there are many reasons why a business owner would consider selling their business. And in fact, the most common reason is they're burned out. They've just been doing it for too long. And the most common burnout period is between 7 and 10 years. So if you've owned a business for more than 10 years and you're starting to feel burnt out, it's important that you reach out and find out your options. Because what happens is buyers of businesses want to buy successful, healthy companies. They're not looking for companies that are broke or companies that don't make money. In fact, they pay premiums for businesses that are successful and well run. Now, the second most common reason is retirement and there's no heirs. The next is divorce, dispute, or illness. And in fact, divorce, dispute, and illness are often immediate events that occur without much notice. So it's important that your business is prepared. Now, of course, insufficient capital to grow is another reason they sell, or achieve estate liquidity. Outside investors want liquidity, and the last reason someone sells is they get discovered. In other words, somebody called them on the phone and said, hey, I want to buy your business. This is probably the least predictable way and it's the one that's least reliable since you never know when, where, or how that phone call is going to happen. Now, the most common question that we get asked is, what's my business worth? And I wish there were a straightforward answer, but there's not, because different types of buyers will offer different types of prices based on the kind of business that we're looking at. Let's take, for example, a manufacturing company. We would have two kinds of buyers there. We would have a financial buyer who would look at the business and based on its cash flow or the amount of revenue that it's generating for the owner on a yearly basis would offer a certain price. But if that business was purchased by a corporation or an investment group or someone who could see taking that and making it part of something bigger, that buyer may be willing to pay more. And I'll give you a specific example. We have a manufacturing company that because of the contracts and the type of agreements from its vendors that it has in place, another company would save over $1 million if they purchase that company. The price there, the business is only priced at $750,000. So the business would be worth up to $1 million to another buyer, which would be more than a financial buyer would ever pay. So the value of your business really comes down to who the buyer is. And that's one of the benefits of having a business broker is we can generate more buyers. We have a better chance of going after those strategic buyers, and in fact, we even have a pure marketing campaign to attract strategic buyers. Now, of course, if you're just looking to value your business, to track where you are, there's multiple different types of ways to value a business. The first is based on its income and how much it produces. The second is the market method. And the third is based on its assets or the ability to replace what it has. So there's multiple ways to value a business. If you're considering getting your business valued, please reach out to us. Be glad to help you out. The next component of the pricing is the financing. And you might say, well, why does financing play into the pricing? Well, if you're selling a business and you want all cash, you may have to reduce your price in order to be able to get the all cash price. But if you're willing to do some seller financing, you may be able to have a higher price and be able to hold back what we call a seller's note. Now, the two main ways that a business gets financed is either obviously all cash or bank lending or seller financing. Now, bank lending, often through an SBA or Small Business Administration loan, is both the buyer and the business must qualify. And just like if you were to get a loan on a house, the house has to qualify and the buyer has to qualify, the same is true here. What we find when we work with SBA or most of the bank lending is that the lender is going to give 80% with the seller holding 10% and the buyer holding 10%. Of course, these are all by negotiations and these can adjust depending on the type of bank that you're working with. These will often take 60 to 90 days to close once the offer's been accepted, and it's not available for all businesses and all buyers. Now, seller financing is a little different. Seller financing is where you as the seller act as a bank. That means, of course, you're going to do the same thing a bank would do. You're going to do a background check. You're going to ask for assets to secure the loan, and you're going to have clauses in there that what happens if they don't repay the loan. Just important to remember that not all businesses can be financed with banks. And seller financing is sometimes the only way to sell a business. The next step is creating an offering memorandum. And this is a narrative about the business. It provides complete disclosure to the buyer of the good and not so good of the business. It gives the buyer a big overview of the business to be able to have a discussion with the business broker to determine if the buyer is interested in moving forward. Often it will have comparative historical financials that are recast. It'll have forecasted financials, and sometimes even it'll have synopsises of contracts, leases, and lawsuits. Let me give you a tip as a business owner. If you're working with a business broker and they are not going to complete an offering memorandum on your business, consider using a different broker. Some business brokers may not do memorandums for all businesses because they'll say they're too small. What we find is when a buyer reviews an offering memorandum, they are significantly more interested and more likely to put in an offer and meet with the owner than if they are taken directly to a meeting with the seller. So it's important that this is a critical step in the selling of a business. This allows the buyer to truly understand the business and to be able to understand the benefits of the business and validate the price of the business. And again, this is only given to a few pre-qualified prospective buyers. Next, once we have the confidential memo created, next is time to market the business. And this is an area where Murphy, and specifically myself and my partner, excel above all other brokers. We create a custom marketing campaign for each and every business. You are not just a listing. You are a business, and we treat you with a custom campaign. That includes online marketing. That includes outreach to acquisition partners. That includes custom ads. That includes a national broker network. Because of our specialty in marketing, we quickly pinpoint and target your ideal buyer, and we go after that aggressively to be able to bring in as many buyers as possible, because we know more buyers means a higher price for you. Now, our buyer strategy is pretty simple. It's 4 specific steps. First is we want to pre-qualify the buyer. We want to find out what skills, what financials they have, what abilities they have, what their expectations are, what they're looking for, what geographical area. We want to define where they are. Then we're going to ask them to sign a non-disclosure or confidentiality agreement. And this simply says that they will not disclose any information to anybody regarding your business. They are not allowed to say anything to anybody. Next, once we've pre-qualified them and it looks like they may be a good candidate for your business, we're going to go ahead and review the confidential memo with them and go through that step by step, verifying that they feel the price is appropriate based on what the information they've seen. And if and only when they agree that everything makes sense, we'll go ahead and do a seller meeting. What this means is we're going to have less seller meetings with you, which means that we're going to waste less of your time. We're going to bring you pre-qualified prospective business buyers on a silver platter, and you've got a chance to meet these individuals once they're qualified. We don't want to bring tire kickers, and you're not going to get to meet every single buyer that we talk to that just wants to know what business it is so they can get the inside scoop. We're only going to introduce you to qualified potential buyers. Now, of course, your job is to evaluate the buyers. Are they somebody of integrity? Do they have the financial capability? Do you feel they have the skills and ability? And would they be a good cultural fit to purchase your business? And these are things that we ask of the seller to review to make sure that you're making a good decision when you sell your business, especially if you're holding a seller note. Now, once the buyer has passed your approval and our approval, let's say the next step is an offer. They go ahead and make an offer, and we ask the offer to be done before due diligence. And the reason we do this is many buyers want to get into the nitty-gritty of your business and find out how you work and all that information, and it may not be with good intent. And what I'm telling you there is we've had buyers in the past who've pretended to be a real buyer, but we found out later what they were trying to do was figure out how that business became successful so they could duplicate it and compete with them. We don't want to release any of your confidential information to somebody who could have ill intent. So we ask for the offer to be done far before the due diligence. That offer also outlines the process for due diligence, the time frames for due diligence, and the process to get to closing. So when you're working with a broker, they manage the offer process. They make sure to get that offer done, and it prevents analysis paralysis and also defines what's going to be analyzed so you don't end up sharing a lot of information that doesn't need to be shared, and you certainly don't want to expose your business to unnecessary competition. Now, the due diligence process really should be very straightforward. See, when working with us as your broker, we're going to do a lot of work up front before we ever have a buyer or an offer. So we're going to know a lot of the information that we're providing is already accurate and on point. So due diligence really is a process of just verifying the information that we've already provided to a buyer. The biggest part of due diligence is verifying financials. This is often where a buyer is going to ask for financial statements. They may ask for bank statements. They may ask for tax returns. They may ask for any information that's going to verify the financials because that's the biggest component of what they're purchasing. For many of our sellers, this is simply a breeze. It's really just a process of producing documents at this point. So just expect a lot of copy and filing of documents. And again, this is where we use our outside advisors. Sometimes you'll be using your attorney to advise on terms of the contract, because we'll still be modifying the contract until we go to closing. And certainly your accountant will be leveraged at this point to provide some of the financial information that we need. Now, of course, the buyer will be leveraging their attorney and their accountant as well. But due diligence for most of our sellers goes pretty straightforward. It's just a lot of document production. Confidentiality for most of our sellers is one of the biggest concerns that they have. Certainly you don't want your vendors, your clients, and especially your employees to know that you're in the process of a sale. In fact, we just completed the sale of a very large franchise covering 6 counties, and none of the employees knew the day that the business was sold and the new owners came in. They were surprised. And that's really how we want it to be. When employees find out that a business is for sale, oftentimes they start looking for another job, and that puts the business owner and the integrity of the business at risk. So when we go through due diligence, it's a little bit harder to maintain confidentiality, especially if you're trying to sell the business yourself. So when we sell a business, within our contracts, we have a very short time for due diligence and very specific time frames and specific documents that will be asked for during that process. And because we're managing the process and we know the process and we've gone through it a million times, we know exactly what needs to happen, when it needs to happen, and how to streamline that to prevent a breach of confidentiality to your vendors, your customers, and especially your employees. Now, of course, honesty is always the best policy when working with a buyer, and certainly we'll want to encourage you to be upfront about all the components of your business. Once due diligence is done, the next step is to go to closing. And part of closing is the prorates and the fees. Of course, there is a closing fee. We use a closing attorney. Some will use a title agency to close to do the closing, and that is typically a fee, could be anywhere from say $1,000 up to $4,000 or $5,000 depending on the complexity. Oftentimes we see them around $1,500 in this area, and it's often split between the buyer and the seller. Prepaid expenses and work in progress, of course, are going to be prorated back to the seller at closing as well, and inventory gets reconciled at closing. And I want to give you a caution here if you're a business owner. Sometimes the inventory counts on balance sheets and spreadsheets aren't always accurate. And what happens is if we say there's $1,700 worth of inventory and it turns out to be $7,000, that's a surprise a buyer doesn't like. So when you do list your business, it's important that you get an accurate inventory amount so that the buyer does not get any surprises, because oftentimes in contracts, the inventory amount will adjust the final price. So it is important that that is accurate at the time of listing. And of course, one of the last steps is negotiations and closing. We want to maintain positive and flexible attitude. You're going to be asked for a lot of documents. You may have to negotiate the price all the way up into the closing table. It's important that you remain positive and think of the big picture. Don't get stuck on little things. Don't get concerned over the small things. Be responsive to reasonable requests and focus on what's really important. Now, after you've sold your business, post-closing, you're still going to have to work on any representations or warranties that you've offered. You may have been asked to provide an earn-out where the buyer the business is valued based on its earning potential over a period of time. There may be some escrows. If it was an all-cash sale, the buyer may have asked for some monies to be held back for a period of time to make sure the business does what you say it does. So at this point, you want to make sure that you extend courtesies. Play nice. Work with the buyer, because there's going to be negotiations that are still going to have to happen even after closing. Keep in mind, you're typically going to have a transition or a familiarization period, which can be anywhere from 2 weeks to 2 years, depending on the type of business that you have. So you're going to have some relationship with this buyer. It's not going to be forever, but it will be for a short period. And the more courtesies you can provide, extend to them, the better that working relationship will be. The first most common mistake that we see is sellers wanting an unrealistic selling price. Now, myself, I ran a multi-million-dollar marketing distribution company, and my partner, he owned and sold a multi-million-dollar packing and distribution company himself. We both have been business owners. We both understand what it's like to start from nothing, build up a business, create millions in that business, make it almost as if it's a part of ourselves, and then have to walk away from it. So we understand that in your mind, that business is highly valuable because it's your blood, sweat, and tears. But we also understand, talking to buyers day in and day out, what they're looking for. And let me give you an example. If your business generated, say, $100,000 of cash flow, and a buyer was looking at businesses, oftentimes buyers will look at multiple different types of businesses. They're not specifically looking just for your business in many cases. So they'll compare your business to other businesses on the marketplace, just like we do with anything in the marketplace. If we're going to get something to eat, if Chinese is cheaper than Mexican, we might go to the Chinese restaurant. It's not necessarily that we're looking for Chinese. Now, if we are, obviously we might pay a little bit more. But it really comes down to the buyers. So if your business is generating $100,000 of profit and you ask $1 million versus another business that's generating $100,000 and they're more reasonable and asking $200,000 as the price, you're going to find that more buyers are going to flock to that $200,000 price business, and your business is going to sit. And this is the number one reason that you'll hear a statistic that 20% of businesses sell, because the majority of sellers are not realistic with their price. And we understand it's your blood, sweat, and tears. We work very hard to get you the maximum price and to do everything we can to bring you the highest and best buyer. But you have to be realistic with what your business is worth. Now, the second most common mistake that we see is a business owner that's neglecting to run the business. And this happens in one of many ways. The first way is a business owner that's burnt out, and they're really just going through the motions. They're tired, they don't want to do it anymore, and they just said, if I could just do this one more year, and they've been doing that for the last 5 years, and the business is maybe flatlining in growth, or maybe is even declining. And they finally decided, okay, I'm just going to sell. The business has been neglected. And oftentimes buyers see that and they discount the business because of it. The second way that we see sellers neglecting their business is when they go to sell their business. Sometimes business owners will try to sell their business themselves, and they'll put their eye on selling the business, marketing the business, getting all these buyers, talking to all these buyers, feeling like there's a whole bunch going on, and in the meantime, nobody's running the business. So the business that was doing maybe $100,000 of profit is now all of a sudden doing maybe $70,000 or maybe $50,000 because they've taken the eye off the ball and they've stopped running the business. This is one of the most common mistakes and one of the most common ways to devalue what you get in the sale of a business. Now, the third most common mistake is not fully evaluating the buyer. And again, oftentimes we see this when sellers try to sell their own business. They get so excited that they've got someone that called them on the phone and said, hey, I want to buy your business and I'll offer you $1 million. And they get all excited and they go home and they tell their family, I'm going to be rich. They're where they want my business. The call finally came. And what happens is, as that buyer goes through the due diligence, they have a practice of offering a very high price, getting the seller enrolled in that vision of selling their business, and then slowly as they find problems with the business, which every business has hiccups and challenges, that price went from $1 million to $750,000 to $500,000, and before they know it, they end up selling their business for $350,000. And it's sad, and we see it happen over and over and over again. And the saddest part is the seller never knew what their business was actually worth. They got allured by a buyer that they didn't completely evaluate. So be cautious of that phone call that comes and says, I'm willing to buy your business and I'll pay you whatever the price. If you go through a strategic process through listing your business, you'll know what your business is worth. You'll get the maximum value. And if the more buyers that you have, the more choosy you can be and the better buyer you can pick to run and operate your business. Now, the fourth most common mistake that sellers make is negotiating with only one buyer. And this links back to that phone call. And this is where we often see that is someone gets a phone call and they go, oh my God, this is the one. I'm going to sell. I'm going to make $1 million. And when you have one buyer, what happens with that one buyer is that one buyer knows there's no competition. So they can engage you. And oftentimes when you're trying to sell your business by yourself, and this is where we often see it because brokers have often more than one buyer for you, is they'll start with due diligence and put you into a contract later. And what they're trying to do is lock you in to falling in love with them as the buyer so that they can get the lowest price. And this is common in the industry. We see it all the time. And so when you have one buyer, they know there's no competition. They know there's no marketing for you to be sold. So they pretty much get to call the shots. And that's a disadvantage to our sellers. That's why if you were to list your business with a broker, the broker's going to put it out there and find as many buyers as they can and attract as many buyers as they possibly can so that they can, at least this is the way we do it, so that we can have a controlled auction. We want to have as many people looking at the business as possible so that there is that fear that there's somebody else and that they follow the process and they don't try to take advantage of you as a seller. Now, the last most common mistake we're going to talk about is being a nitpicking negotiator. And I'll tell you where this comes in. This comes into due diligence. Because what's going to happen in due diligence is the numbers that you gave up front are all going to get verified. And inevitably, there's going to be some discrepancies. That's just the way it is. Nothing, and I do mean nothing, is 100% accurate. So let's take your inventory. Let's say in the beginning, you thought you had $1,700 worth of inventory. Well, it turns out in the end, you had $7,000. Well, the buyer is going to be a little bit surprised, and they may start to back away a little bit. You can say, well, it's my principal. I paid for this. You've got to buy it from me. And you could lose the entire deal over that. Or you can say, you know what, I understand that you were only expecting $1,700. Let's work it out. Let's do it this way. Let's negotiate some terms in here. Let's put maybe some strategy into how we do this. So you want to keep that in mind. And also remember you're going to have some prorations. Work with the buyer on those. You may have some things that you've prepaid for that the buyer was not aware of, and they may not have the funds immediately to compensate you for those. So you want to be able to be a little bit flexible as you go through the process. No one's telling you definitely to give your business away, but be flexible with the buyer. They may not have expected these additional costs when they initially made the offer. Now, the big question I often get is, should I use a business broker? Well, a business broker is a trained professional in the art of transferring businesses. This is what we do all day, every day. We don't sell houses. We don't sell land. We don't sell office space. We sell businesses. And we have databases full of buyers looking for businesses. So our first role is to help you as a business advisor, is to help you prepare your business. What is your business worth and how can you get the maximum value? We'll often come in weeks, months, or even years, sometimes decades before you're ready to sell to help you prepare your business in order to achieve that amount that you want. See, you will exit your business one way or another. It'll either be through a catastrophic event that forces you to take less than you wanted because you weren't prepared, or a strategic planned exit that allows you to choose when you exit. We've prepared many business owners that chose when they exited and got the highest amount versus waiting for happenstance to occur. Now, of course, we protect confidentiality because we're a third party and we are trained in how to keep a buyer from getting the information unless they are qualified. Of course, our custom marketing campaigns will bring in many more buyers than you could try to do on your own. Plus, our databases and our national network is just something you can't get without using a broker such as ourselves. And of course, we're trained facilitators and negotiators. We don't have any emotion to the price they give us. It's just a price. So we work hard to get the highest price possible, and their emotions can't influence us to tell you to take a lower price. Remember, we're all in this together. We work together for the sale of the business. Now, of course, by having a broker involved, it allows you to focus on your business. We've had many businesses that have the best 12 months the company's ever had because the broker was focusing on selling and the seller and the owner was focused on running the business. We can also help justify the sales price. We have models that can help prove what the business is worth. And of course, the last advantage is we only get paid when the business is sold. If we aren't successful, you don't pay us. And that's the only disadvantage, is you do pay a success fee for our services, just like you would pay for an attorney or an accountant. So why would you use us? Well, there's multiple reasons. The first being the high level of professionalism. Rarely will you find one individual, let alone two, that held themselves to some of the highest, not only ethical standards, moral standards, but business standards. My partner, Bill Yankee, has been in a CFO for a small publicly traded company that bought and sold manufacturing and service-based industries. I myself ran a marketing company, a multi-million-dollar marketing company throughout 22 countries, and understands marketing better than any business broker out there. And most of our clients say, you know what, we rarely work with people that are so responsive, that are so experienced, that truly understand how to help me. Now, of course, we have a network of brokers that helps us find buyers, and our partnership. There's two of us. So when you work with myself, you work with Bill Yankee as well, and there's two of us that go out there and market the business on a daily basis, that are looking for buyers, that are constantly finding opportunities to be able to sell your business at the highest price. So you won't find a more qualified team anywhere in the Jacksonville area or Florida area if you looked. Now that we've gone over the process and some common mistakes about selling your business, if you're considering or just curious about the process of selling a privately held business, feel free to contact us for a complimentary confidential meeting. And we'll be more than happy to help answer any of your questions, help you understand the process, and see if your business is ready for you to exit. Also, feel free to download our free report called 7 Critical Points Every Business Owner Must Know Before Selling Their Business. You can go to our homepage at sellyourbusinessflorida.com, and there's a link there where you can type in the short link here listed. Also, feel free to contact us directly at 904-571-9580.